How to get whole life insurance right for maximum cash value. In this video, we are going to talk about sales professionals. So in working with sales professionals, especially among successful ones, there is one common trait: time. They don't have time. They want to see what it is we're going over, have enough information. This way they can make a decision and move on and get back to their primary job, which is selling more people, finding more prospects, because that is how they make a living. Really, they're their own business owner in a lot of ways. But when working with sales professionals, this is very important. If you are a sales professional considering high cash value life insurance, you may have been pitched on it before or may have felt like this before, as far as, hey, I was shown a policy, but then after the fact, I was shown a better one. That's not what I want. Like, I don't have the time to sit there and try and figure out what option I should go with, what policies maximize the cash value. Just show me the different options, but show me the ones that are truly maxed out for cash value, because I've heard of all the great things about it: safe, liquid, tax-free area to position money, always accessible via policy loans, money keeps on compounding. But I do not, under any circumstances, want to be taken advantage of, don't want buyer's remorse, and this is your money, not the insurance agent's money. That's the thing at the end of the day. So how do commissions work? That question comes up a lot of times. Sales professionals often ask that question so they can compare it to their own field as well. So what to look for when opening a policy? Number one thing to look at, if cash value is your goal, the first thing to look at is the cash value. Specifically in the first year, we're going to go through exactly what to look at in a second. Company selection, and then also flexibility. As a sales professional, what happens to income? We want it to go like this, but sometimes it'll go like that, up and down, because life happens, we get sick, hurt, whatever it might be. So things to look for here. When done right, a policy is a safe, liquid, tax-free area to position money. I've got that growth rate between 3 to 5%, tax-free as well if I don't mech it out. And then I can access the money and my money continues to compound. Properly designed whole life insurance products. Year one, specifically looking at the cash value, I should see between 85 and 90% when max funded. What that means is it has to do with the third bullet point on flexibility. If I want the option or ability to pay in $100,000 per year, but I don't want to get a bill for it, I can literally commit to $10,000 approximately and just add more funds into the policy at my discretion. Now, when I will see that 85 to 90% in the first year is when I max fund it and pay in the full desired payment. So if it's $100,000, I can commit to the minimum $10K. That won't generate much cash value, but everything above that, above and beyond that $10K will. Same thing if my maximum is $10,000. I can commit to $1,000, add more at discretion. So 85 to 90% in the first year. Break-even point between years 3 and 5. And then flexible, not locked in to high payments where it feels like a burden. That's the last thing that I want. 4 major mutual companies: Mass, Guardian, New York Life, Northwestern Mutual. Cream of the crop in terms of always delivering strong cash values. We've seen it consistent, talking about actual policies, not just projections or illustrations, real delivery. So what we are going to demonstrate here is a bullet point really touching on the flexibility. An individual who wants the ability to pay in $50,000 per year, but doesn't want to get a bill for $50K, and some years he can't pay in $50K. Let's see what it looks like. So this will demonstrate the ability to adjust payments and have a very flexible policy over time. We also are demonstrating what's called a MEC catch-up payment that has to do with the taxable limit on a policy. In this version here, we don't trigger any taxable event. We always avoid that. So on the left, we've got a policy where he is max funding from day one. $50,000 per year for 10 years. There we go. Minimum premium, $5,000. PUA payment, plowing money toward the cash value, $45,000. 10/90 split. There is a term insurance rider in there as well, and that's a big reason we see the cash value about $44,000 right off the bat. Break-even point between years 4 and 5, really year 5, I've paid in a total of $250K and I've got 252 at that point in time. So this is a policy where the policyholder, this individual, can literally commit to the 5K and add more into the policy at discretion, totaling 50 per year. Very flexible. Now let's assume he purchases this policy, but then life happens, other expenses come up, whatever it might be, it happens to us all. What does the policy look like if he does not fund it according to schedule? Same policy, exact same product, but funding it in a different means. We are not locked in to this payment if this is the policy we sign off on. We have that flexibility. If the premium's low, if it's all premium, we are locked in. So here you see, year one, 25,000, 25,000, 25, look at this. But then year 5 makes a huge catch-up payment, plows in $150,000 and makes up for lost time. You do have the ability to do that with whole life insurance policies if the insurance company allows it. This one does. So even though we have that $5,000 minimum premium, we can make a huge catch-up payment. In essence, we're just making up for lost time. All the years we could have paid in $50K per year, we did not. Here's a big payment. Cash value is close to where it would have been otherwise. We do see a difference here. Why the difference exists is really due to time value of money, compound interest over time. Here, we're paying in 25 per year compared to 50 per year. When we pay money into the policy is when the guaranteed rate and dividends begin to be applied to our cash value. If they're not in there, not going to happen. It'd be nice if catch-up payments would date back to day one, but they don't. Now, at the end of the road here, end of 10 years, or I'm sorry, 10 years over here, we've paid in how much? 500,000. In this example, we paid in 500 over 12 years. Took a bit longer. So the 12-year mark, I've got 604 versus over here, 637. That's time value of money, just the interest from getting it in faster, accruing faster versus not. The point is we're still getting money into that safe, liquid, tax-free area, still growing the death benefit over time, design the policy so it can handle those additional payments without any medical underwriting. That is so important. But he's got that flexibility now to adjust payments over time. So this is typically very valuable to sales professionals in order to not be locked into a policy. That's an item that comes up frequently where we feel like, oh, I wish I would have known that before, because now all of a sudden I could have kept that policy in force and not lapsed it in the past. If someone's in a situation where they bit off more than they could chew and it was all base premium. In any event, I hope this helps. Reach out if you have any questions at all, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.